Imagine two people. One earns $60,000, owns modest assets, and sleeps well. The other earns 3 times more, but owns almost nothing. The higher earner looks wealthy. A better apartment, newer car, constant restaurants, expensive trips. Yet, every object is attached to the next paycheck. The lower earner receives less, but keeps a meaningful peace. Month by month, that leftover becomes savings, investments, and a small claim on the future. Put their finances on a scale, and the illusion breaks. A large salary can be outweighed by debt, fixed costs, and permanent obligations. Now switch off both salaries. The expensive lifestyle begins collapsing immediately, while the modest household still has reserves and assets supporting it. That is the difference between income and wealth. Income measures how much money moves through you. Wealth measures what remains after the movement stops. Think of 2 counters. One resets every payday. The other remembers every dollar you kept, every debt you removed, and every asset you acquired. Your salary is water entering a reservoir. Housing, taxes, food, transport, debt, and lifestyle are holes constantly draining it from below. A bigger pipe does not guarantee a fuller reservoir. When the holes expand faster than the inflow, a raise changes almost nothing. Only the portion redirected into ownership stays behind. That small stream, repeated for years, matters more than one impressive month of income. The Federal Reserve shows how different these worlds are. In 2022, top 10% income began near $245,000. But top 10% wealth began near $1.94 million. A high salary can arrive quickly. Capital usually requires years of accumulation. A promotion changes your paycheck overnight. Wealth grows more slowly, through repeated decisions that look almost invisible while they are happening. Every payday, taxes and bills remove their share first. What builds wealth is not the original envelope, but the narrow strip surviving afterward. That remaining strip becomes a bridge. Without enough saved beneath it, your entire lifestyle still depends on every future paycheck arriving on schedule. For decades, a 6-figure salary symbolized success. Reaching $100,000 felt like crossing a permanent line into financial security. But round numbers do not protect purchasing power. Inflation keeps moving after your career milestone, quietly changing what the same salary can buy. Between January 2020 and January 2026, consumer prices rose roughly 26%, according to the Bureau of Labor Statistics. So $100,000 in early 2020 required about $126,000 by early 2026 to buy roughly the same basket. That means a 20% raise can feel like progress, while still leaving you with less real purchasing power than several years earlier. Nominal income may rise on a beautiful chart, while purchasing power crawls below it. Your title improves, but your options do not. The clearest example is housing. Salaries climb step by step, while desirable homes can accelerate upward like they are attached to a rocket. High-paying jobs are also concentrated geographically. The biggest envelopes are pooled towards cities where rent, transport, services, and childcare cost more. An employer may pay you more because the location demands it. Part of the raise is compensation for entering a more expensive environment. Move farther away to reduce rent, and the cost returns as commuting, fuel, train fares, parking, and hours taken from your day. Lost time creates another bill. Delivery, taxis, convenience food, and paid services become rational purchases when work consumes most waking hours. By 2022, the median American home was worth more than 4.5 times median family income, above the pre-crisis peak. Older generations often faced smaller houses and higher mortgage rates, but the price of entry relative to income could still be far lower. The result is strange. A larger paycheck can become an expensive subscription to the city where that paycheck is available. Then comes lifestyle inflation. Each promotion lifts the envelope, but it also adds new weights to the person carrying it. At first, the raise feels like relief. There is finally room to breathe, replace something broken, and stop checking every small price. Then, temporary rewards become permanent expenses. A better apartment, newer car, premium phone, frequent travel, and subscriptions nobody remembers choosing. The celebration ends, but the payments remain. What felt like a reward becomes another automatic claim on every future month. A larger apartment brings higher rent, furniture, utilities, and location costs. The upgrade is never only the number shown in the listing. A newer car arrives with financing, insurance, fuel, maintenance, parking, and depreciation. The purchase price is merely the opening scene. A bigger home adds repairs, taxes, heating, cooling, furniture, and endless small projects. More space creates more surfaces demanding money. Social comparison accelerates everything. People do not judge comfort in isolation. They compare restaurants, neighborhoods, vacations, schools, and cars with people nearby. Research on expenditure cascades suggests consumption pressure can travel down the income ladder as one group imitates the standards above it. So the financial target moves. First you need 100,000, then 150, then 200, still feels strangely insufficient. 3 different salaries can produce the same leftover amount, when each new level immediately creates a more expensive version of ordinary life. Eventually, the higher income has not purchased freedom. It has simply transported you into a system with larger numbers on both sides. From the outside, the result looks rich. Polished apartment, new car, good clothes, restaurants, and photographs from distant places. But ownership strings reveal the truth. The apartment belongs to a landlord, and the monthly payment builds someone else's balance sheet. The car may belong economically to a lender, while depreciation removes value, even as the monthly payment continues arriving. The phone, holiday, and restaurant bill can outlive the experience through installments and revolving credit, stretching yesterday's consumption into tomorrow's income. Even time can be rented. When the lifestyle requires the job, evenings, weekends, and career choices begin belonging to the next paycheck. The entire structure becomes a hanging mobile. It looks balanced only while one central salary string stays tight. In 2025, only 63% of American adults said they could cover a $400 emergency using cash or its equivalent. High earners are generally better prepared, but fixed costs can still make a large income household surprisingly fragile when one emergency arrives. If expenses rise whenever income rises, financial margin remains unchanged. The wall becomes taller, but the space behind it never expands. At that point, the person has not become richer. They have become more expensive to maintain. Now, close the salary valve. Rent, car payments, insurance, tuition, debt, and subscriptions do not politely pause with it. They fall like dominoes, because most obligations are fixed, while employment income is conditional. A high salary often rests on fragile supports. One role, one industry, one city, good health, useful skills, and cooperative management. Economists call this earning ability human capital. For most workers, it is their largest asset during the early part of a career. But human capital must keep working to produce money. Unlike a building or portfolio, it cannot be sold separately from the person. It also cannot be transferred to children, stored indefinitely, or activated while you sleep. The owner must remain present and productive. Layoffs, illness, automation, industry decline, or one damaged professional relationship can interrupt a stream that previously looked permanent. Time creates another risk. Skills age, energy changes, and markets move, while well-chosen assets can remain after the workday ends. Someone earning $200,000 and spending $190 may be weaker than someone earning $80 and consistently keeping $20. The first stands on a narrow platform, supported by ideal conditions. The second is slowly constructing a platform that can support itself. One walks a paycheck tightrope, carrying heavy obligations. The other builds a wider path from reserves, low debt, and ownership. A decisive change happens when salary stops being only spending power and becomes a tool for buying pieces of productive systems. A worker is paid once for one completed task. To receive another payment, the worker must perform another task. An asset can behave differently. A property, business, or portfolio may generate repeated returns after the initial purchase, though never without risk. Ownership is not magic. Homes can fall, companies can fail, and markets can crash. But ownership changes who receives long-term economic growth. A renter sends part of every paycheck toward another owner. The payment purchases shelter, but usually leaves no growing claim behind. In 2022, median homeowner net worth was about $396,000 versus roughly $10,000 for non-homeowners. That gap does not prove a house automatically creates wealth. Higher income, older, and already wealthier families are also more likely to buy. Still, the pattern reveals something important. Large fortunes are usually connected to ownership, not merely to impressive annual salaries. Salary pays for the present. Ownership can gradually buy options, where to live, when to work, and which risks to refuse. Wealth statistics can hide this difference. In 2022, mean American family net worth exceeded $1 million. But median net worth was about $193,000. A small number of enormous fortunes pulled the average far above the typical family. The median asks a better question. What does the household exactly in the middle own after subtracting everything it owes? A person can rank near the top by salary and remain far lower by wealth because assets are distributed much more unevenly than income. Another person may report a modest salary while controlling property, businesses, and portfolios that provide far greater financial security. The most revealing question is not, how much do you earn? It is, how long could your life continue if the salary stopped? In 2025, 55% of adults had emergency savings covering 3 months, while 30% could not cover 3 months by any means. That runway is what converts money into negotiating power. It lets you survive emergencies without accepting the first available bad decision. A high salary is still an extraordinary tool. The mistake is treating it as permission to make every part of life permanently more expensive. First, use it to build an emergency reserve strong enough to absorb repairs, illness, or unemployment without creating new debt. Next, attack expensive debt. Every high-interest payment removed is a future piece of income that no longer belongs to a lender. Then, invest in skills carefully. Education is valuable when it increases durable earning power, not merely when it produces an impressive credential. Use money to reclaim time where it matters, reduce destructive commutes, protect health, and create room for better long-term decisions. Convert another portion into diversified assets, not because markets only rise, but because ownership gives savings a chance to compound. A business can also transform labor into a system, but only when it serves real demand and survives without consuming every hour. The central number is the gap between income and required spending. That gap is the raw material from which wealth is built. A smaller salary with a large savings rate can build wealth faster than a larger salary whose entire increase disappears into lifestyle. When a raise arrives, keeping your old cost structure even briefly can redirect almost the entire increase toward future ownership. That creates options. A longer emergency runway, more investments, the ability to change jobs, move cities, or take a calculated risk. But when every raise immediately becomes a larger mortgage, newer car, and recurring service, the golden cage becomes more comfortable and harder to leave. The highest paid worker may look powerful while being trapped by obligations. The modest owner may look ordinary while quietly controlling more of life. Return to our two people. Their salaries were never the real contest. The contest was between consumption that vanished and ownership that remained. When the large paycheck stops, rented symbols leave first. The apartment, car, and lifestyle reveal how little security they actually represented. The smaller envelope, repeatedly converted into reserves and assets, becomes a machine that can support tomorrow without rebuilding everything from zero.